First of all, thank you for all you've done, all of you, for this conference over the last couple of days, and also for taking part in this. If I could have everyone's attention, please, that'd be great. So let's start by having everyone introduce themselves one more time. I know you've done it a few times but Sunil, why don't you start with yourself?
Yeah. My name is Sunil George, and I'm from STS Global, which is my own company. I'm a trade and trade finance guy throughout my life for the last 27 years. I make it brief. That's it.
Sounds good.
I'm Marc Ostwald. I'm the Chief Economist and Global Strategist at ADM Investor Services, the futures clearing arm of and brokerage arm of ADM.
Excellent.
Hi, I'm Dennis Rivera, CEO of Advanced Alpha Advisors, a registered CTA with the NFA. I advise and consult with family offices, QEP investors, and institutional investors on their selection of managed future strategies, which I construct for their portfolios.
Sounds good. And by the way, thank you for filling in today on a very short notice, so it's much appreciated. Well, let's start with table one. Marc, what were you discussing at your table? What was the topic, and what were the key takeaways?
Well, the first question, actually, it's probably worth bringing up because it's not been that much discussed, but in his initial presentation, Ed Morse was talking about the United States being 6 countries.
Right.
And as much as, it took a moment for me to think about it, I was trying to explain how, there are very regional issues and how that hampers actually the United States at a federal level from putting things in place, and but how it's also true. This is true across the world. Everyone has a problem. In most countries, even if they're not actually a federal country, or in the case of the EU, they really struggle to come to an agreement on everything, which is where we've got a lot of the political paralysis from, which has driven this polarization towards left and, well, above all, towards the right. Next question I had was about sanctions. Do they actually work? And as I was trying to explain, basically, they don't work. In certain senses, what they do is effectively reroute things. So I was giving the example of, if you look at EU imports from Russia, they don't import pipeline gas, but they do import a lot of LNG now. If you look at the raw numbers at a national level of, say, German exports to Russia, they've collapsed. About 90%. If you then do that little bit of exercise of, but German industry doesn't seem to have collapsed under it, given that Russia was quite a significant trading partner, and the answer is no, because you need to go and have a look at those exports to places like Uzbekistan, Tajikistan, Azerbaijan, Turkmenistan, and you suddenly see these vast increases of 300 to 500%, which say, oh yeah, right. What are those economies must be going really quickly. No. It's not different really to China using connector economies, a theme which we've seen across the conference and talking about that. The third area around which we on both lots groups we were discussing of why didn't we invest in infrastructure across most of the developed world, particularly during the time when we had 0 interest rates? And the answer is, well, there's 2 answers. One, because most of the people there, an infrastructure project lasts more than the term of a government. Someone looking for re-election basically doesn't want to waste, particularly in this day and age, and they've got their sponsors who got willing to bankroll them, but bankroll them for their own things. Infrastructure spending is pretty much nobody's thing. I mean, it is gradually getting there, but we've now got to the point where everyone's going to have to invest in it. Particularly related to power grids, if we're going to increase the amount of power distribution that we've got, and have these big AI centers, whether it's going down the nuclear route or something else, we're still going to have to invest a lot more in that. And the last one was around fracturing of the global economy, deglobalization. Someone was, I think, misunderstood me when I sort of said the US is fracturing. It's like divorcing itself from the rest of the world, and the EU is actually starting to pull together. No, that's not true. The US is definitely wanting to decouple at this particular moment, but the one thing that the EU, if you actually have a look as but one example, whether it's reforming relations in terms of Russia, or above all in terms of reforming the EU, there was a moment of great cooperation at the start of the Ukraine, but 6 months later, all the petty differences that there are, some of them are relating to things which are so historical, and it is a case of get over yourselves, are not. So, yeah.
Wonderful. Thank you for that. Thank you for leading that discussion. Dan, you want to talk about what your table discussed?
Sure. Some of the questions I got during my two meetings with the particular interested parties were, because I'm a specialist in merging managers in the CTA space, they were interested to learn, how do I find managers, number one? What are the fee structures that involved in these allocations for my investors who are QEP family office investors? And how do I manage the risk and monitor these managers with their particular strategy? So I touched on all points, and the important thing was that, I basically advise my investors on their selection of managers, and I do a due diligence on both the investor and the manager. So I have to understand the investor's investment thesis and history, number one. And once I get that and I get all the metrics as to what type of strategy they're looking for in regards to sharp targeted returns, max drawdown, track record, AUM, et cetera, then I will source the managers that would fill that bucket, and we'll start with opening the onboarding process to get them onboarded into an FCM as sub-managers, and then I'll monitor that portfolio for them. So that was basically the main topic of what we spoke about. One of the young ladies at my table had asked me, how do I monitor the risk, the liquidity, and all that? Well, I have access to live accounts and P&Ls at the end of the day, and I monitor that for sizing and VAR and everything else to make sure that the managers are on point with what their disclosure document says and the particular strategy they're trading. Because like I had mentioned, I had to fire one manager because he went off the reservation when he was a crude manager and he started trading corn to offset a drawdown, which unfortunately that doesn't work for me or the investor. And the important thing is that my focus again is on the emerging managers because they don't get the exposure that they typically would like to get. Your consultants and advisors and all these other groups, cap intro teams, investment banks, they focus on a large AUM manager. So I provide a need for them in this space, and the investors get what they're looking for because they're looking for alpha generated out of the smaller managers. They could allocate smaller chunks of capital because the minimum investments are $20 million or more in some cases. And they could allocate to a group of managers in a managed account and notionally fund it, or go into a fund which has a minimum investment, which is a lot smaller than a managed account, but you don't get the transparency and liquidity you're looking for. So that's pretty much it.
Wonderful. Well, thank you very much for that. And again, thank you very much for being here today and helping out. Sunil, you got a lot of notes there. That's
exactly. That's half of that doesn't matter actually.
Buy bread, apples, cheese.
Correct, exactly. You got everything. All right, okay, so it was an exciting opportunity to basically interact with a lively group of people, very diverse background from different industries. So my question which I placed was that, we all know trade finance as a tool for risk mitigation. you need to get paid. Like when you're selling as a trader or a manufacturer, we all have buyers who are taking our commodities or products. So we need to get paid. So if you get a letter of credit, if you get an insurance-backed structure, we are looking at mitigating mark-to-market exposure, and get paid on time and reducing your working capital cost. The more time you take for getting paid for your cargo means the more interest rates you pay as well, one way or the other actually. How do you mitigate that? So I asked a question to the group, like whether the group is aware of trade finance being used as profit enhancement tools, and got various answers. Some of them are using it. I mean, I was very excited to see insurance-backed products. Basically, let's say, like if you really want you have a customer in Pakistan who wants to buy $10 million of commodity from you, and you got a receivable where your internal credit risk team has got an appetite for a $5 million on this balance sheet, and then, okay, you want to get $10 million of limit, you can approach the insurance company and say that, okay, take the $5 million, which is my receivable, as a collateral for you, and give me another $5 million at the back of that, an enhanced credit position, so that I can get $10 million. I can be the good guy. It is done on an undisclosed basis to my customer, tell the customer that, yeah, I really trust you, so take $10 million of open credit. But what is happening is that the insurance company is taking the collateral. They're making some enhanced profitability on their side as a seller of this capacity. But at the same time, as a trader, as a prudent trader, what I will do, I know that my customer in Pakistan is borrowing at 20% or 15%, and I've got this insurance product at maybe 3%, So what I'm telling him is that, I got a wonderful product, but I'm giving you open credit, give me 10%. So I'm talking about flat 6%, 5% on the financing cost, whereby my trade finance instrument has become a profit enhancement tool, not only a risk mitigation tool, actually. Letters of credit. I highlighted how banks are raising money through structured letters of credit, which I'm a practitioner for the last 20 years, all across the globe, starting from China to Brazil to India, everywhere, actually, all across. So this is cheaper liquidity being passed on to emerging markets where the cost of funding is high, but traders have got a huge, they're sitting at the crossroads, access to liquidity and selling their commodity. They can utilize that and make more money, and that's why I'm a practitioner on that as well. And somebody spoke about LCs. They get LCs on a structured fashion, they get back-to-back LCs, master LCs, reissue, structure, bespoke kind of solutions, which is a little more structured, but at the end of the day, money can be made from there. So I believe it was a great and exciting panel. People took something, and I learned from everybody as well, actually. Thank you.
Well, that's the joy of these tables. So thank you very much for that. Really appreciate it. Now, before we release these folks back to the wild, we have time for a couple questions. Does anyone have questions for our table leads before we call up the next group? Do we have any questions? All right, well, let's give these gentlemen a round of applause. Thank you, guys. I don't know whose hand to shake first. There, thank you very much. Please watch your step on the way down there. It's a bit steep. All right, well, at this point, I'd like to call up the next group of table leads. So let's call all four, Elina, Michael, Osama, and Scott, to please come to the front. Now, while these folks are coming up here, a quick announcement. First of all, after this panel, we're going to be breaking for our concluding lunch in the next room. I hope a lot of you will join us. It's good food, and it's one more chance to socialize a bit before we break for the year. Also, commodities people, we've got quite a few employees around the world, and not everyone comes out to every event. We've got probably, what do we have, about 25 people now? 25 people now. So they love to see what's going on at these conferences, and we love to see people's experiences documented too. So as I mentioned at the beginning of this, we have a LinkedIn photo posting contest. You just take a picture of yourself at the conference with you and maybe some of your friends, or in an interesting pose or something fun, and the most popular one will receive a $125 Amazon gift card. So just post your photos with the hashtag commodity trading week. So, all right, let's get into these discussion tables. Elina, let's start with you. You were next on the list, and you were discussing CFTC policy. So, what first of all, why don't you introduce yourself fully, and we can take it from there.
Sure. Lena Zach, BP. I work within the swap dealer BP Energy Company. I'm the advisory officer in New York on the compliance side, and I'm the only ethics and compliance officer in New York. I'm the only member of the ethics and compliance team, inclusive legal, in New York. So I mostly spent some time with Sunil, and we talked about the trade finance piece. But in the second round, I was able to also meet with David and Carl, thank you so much. And we talked about both physical power trading and financial power trading and what Castleton is doing currently. And David described some transactions that he'd done for customers recently. A couple of questions that came up were just, what is the CFTC looking at in terms of business practices and deceptive conduct and transaction surveillance and investor protection? So we mentioned about good business practices being like good reporting, risk management, adequate compliance programs. We talked about deceptive practices being, or deceptive conduct being our spoofing, misappropriation of material non-public information. And we had a chance to sort of talk about the different structures that our firms were sort of, I wouldn't say like engaging in currently, but just what we've seen specifically in the industry, nothing specific to each of our firms, but just what we've seen in the past based on our experience.
Excellent. Well, thank you for that. And I should have known that when I said take notes, you would be very diligent about your note taking.
Yes.
So.
I actually thought she had a PowerPoint presentation. It looks so good up here.
Excuse me, I have to plug this in.
Yeah.
Yes.
It was a PowerPoint presentation.
Michael, why don't you introduce yourself and talk a little bit about what you were working. Here you go.
Thanks so much. We had a good talk over table 5, and we're focused on foreign trade practices. So my background is with Mitsubishi Corporation here in the U.S. and the Division Compliance Officer. I'm in charge with regulatory compliance across the metals trading group primarily, and that encompasses both markets compliance and trade compliance. So focusing on trade compliance today, some of the issues that came up during the conversation were really about getting into the weeds of how a product is defined, right? What is the proper harmonized tariff schedule code for your product that you're importing? And as we touched on briefly during the presentation, very small differences in the grade, maybe if it's in refined products, the blend can result in a different tariff code. And that could mean a different tariff rate for your imported product. We also talked about what would constitute a substantial transformation. And for those of us who have been in business for a little while, we know that that has a very legal definition to it. When we take a material and turn it into something else, that can often affect what is the country of origin. It can redefine the country of origin. It can also define how the product is treated for tariffs. Now, the point here with respect to substantial transformation and harmonized tariff schedule is that it can be different. It can be different for different products. It can be different for metals. It's different for energy. It can be different for crude oil versus refined products. It can be different for aluminum versus copper. So the biggest takeaway that I had from the two conversations that we had was that you have to get into the weeds with this stuff, and you have to have the resources to do that. Now, those can be internal resources for your, from your legal and compliance professionals internally, but we're generally stretched pretty thin, and it's going to be very difficult for us to keep up with all the tariff changes that are happening pretty much on a daily basis, 24/7. And so, I would encourage firms to definitely engage with an external law firm. External law firms should have the expertise in this area in trade compliance. And really, I think the biggest takeaway is that as commodity trading firms, we need to start to elevate, if we haven't already, elevate trade compliance up to the level that we have our markets compliance.
Excellent. Well, thank you very much. I think everyone's got one. Yeah, there we go. Thank you very much. That was a great summary of the discussion. Next, let's go to Osama to discuss what you had at your table.
Thanks, Howard, and thank you, everyone. So my name is Osama Shaheen. I work with Gunvor USA. I'm a power and gas trading compliance advisor. I support our power and gas traders in Houston, Calgary, and here in Stamford. I used to work in Calgary, Canada, and relocated to Stamford 6 months ago and loving it. So I just hosted 2 really focused roundtable sessions on how we as a community adapt surveillance and compliance frameworks for real-world trading. I tried to make it focused to power and gas. That's my background and expertise. So the first question was around physical and financial surveillance. Everyone commented that both must be integrated, with cross-market manipulation between physical and financial products being the #1 risk that the FERC and CFTC is focused on. So traders today can shape physical flows, schedules, or ISO bids, and simultaneously hold correlated futures, swaps, FTRs, so financial transmission rights, or as they're known in other markets, CRRs, congestion revenue rights, or TCCs, transmission congestion, I forget what the last C is. Contracts, there we go. That's why I have these guys. That's why I have professionals on stage. Or RA, resource adequacy, yes, products. So there's a lot there, as you can see, that are correlated in the financial space and can impact physical. So surveillance must not look at these books in isolation. There needs to be a system, a tool, maybe it's a combination of Power BI reports and your ETRM that you're pulling on that flags alerts between uneconomic or loss-making schedules that align with profitable future positions. So yeah, we need surveillance logic that connects physical bids to derivative P&L, not just kind of check them separately, because then you're kind of looking at them in complete isolation. A way to link those is based on specific node or hub in your respective markets. We then spoke about off-channel messaging and ephemeral communications, and how that still creates a great deal of exposure. So the comments were that policy alone isn't enough, and that maybe some firms are banning or restricting WhatsApp completely, but traders are still using them informally. So I think everyone agrees that written policy is baseline and rolling that out, but what really enforces it is culture, and that comes from the top down. So people must feel like, traders must feel safe escalating if they see something wrong, and consequences must follow breaches. So I think there's that sense of, if there's personal liability, the traders will take it a bit more seriously and pay attention.
Wonderful. Thank you very much. Sorry, I got a little distracted by the screen just blowing in and out there for a minute. So, but thank you very much for hosting that table. It sounds like it was a great discussion. Last but not least, we have Scott. Scott, why don't you introduce yourself and talk a little bit about your table?
Sure. Well, thank you, table.
The winning table!
Listen, we had a really great time. My friends from...
I didn't know we served cocktails for this.
Listen, yeah, we had such a good time. I had some participants at my table that stayed for the second round. I was impressed. I was honored. We got into a really great chat. So we come at this. Everybody at the table. There was some folks from more of a vendor background. There was certainly some folks from large corporates, of which I would count myself. We're all kind of a blend of technology people that have pretty intimate knowledge of the markets we work in, right? And what we really kind of connected on was essentially this idea that, like, you know, the different software vendors out there, like, they want to be everything for your portfolio, but in reality, to get the whole truth about your portfolio, you have to have a system of systems, and you have to have the proper integrations between things to actually see what's going on, and that applies to compliance, right? You mentioning Power BI is actually like exactly the type of thing we're getting at, which is like, there's a lot of work in getting clarity out of like ETRM systems, because you can find yourself in a situation where the data might be right for one purpose, but it doesn't reflect enough detail to do activities like compliance or risk or all the different functions you need to do. We all sort of ended up finding that we all are building platforms at our firms to do the things that our systems have gaps in, right? And that's just become sort of a requirement, right? And that's why really the key thing is that, you know, don't underestimate the complexity of getting portfolio insights and even being able to do things like compliance, right? Because it is not going to easily come out of your system, especially as your business gets more complex. So handling that complexity was a big thing. We did touch on AI, since how can you talk about technology without talking about AI right now? I thought a really great thing from our folks from Occidental was this idea that, hey, we're not looking for AI to like replace humans per se, but the idea that came out was we're using AI to fast forward like a VCR, for anybody that remembers, to fast forward to where the issues are in our data, in our portfolio, so we can focus on those issues more directly, rather than, you know, being faced with terabytes of data to wade through.
And for those of us who do remember VCRs quite clearly, I will point out there's been that story going around that a AI was beat by an Atari 2600 in a game of chess. So, you know, there we go. So that's some good things there. But no, thank you very much for that insight into your table. And it sounds like it was an enthusiastic table over there. So nice job. Now, we do have time for a couple questions, but before we do, I got to get my own photo entry for this contest. So I'm going to count to 3, and when I get to 3, everyone smile, put your hands in the air, and yell, "Commodities!" Okay, ready? Let's see. 1, 2, 3.
Commodities.
There we go. I got it. Good shot. All right. Does anyone have any questions before we break? Do we have one over there? No, I'm not eligible to win. I just do it for bragging rights.
I'll post that for you, Howard.
Sounds good. I'll send you.
Free conference admission.
Exactly. Any other questions? All right. Well, seriously, for those of you who are here at the end of the conference, thank you so much for staying, for participating throughout this whole event. I hope you found it interesting. I hope you found it enjoyable. And most of all, I hope to see you again next year. On behalf of myself and the entire Commodities People team, thank you very much. And we wish you safe travels back to wherever you're going. And we look forward to seeing you in the future. Let's have a round of applause for everyone who stayed till the end here.